Most people think investing success comes down to picking the right stocks, finding the next big winner, timing the market, getting in early. But in reality, long-term success usually comes down to one decision. Do you invest in index funds or actively managed funds? And that one decision can cost or make you tens of thousands of dollars over time. Let's break it down clearly using Canadian examples. An index fund simply tracks a market. In Canada, that is often the S&P TSX Composite Index, which holds the largest publicly traded companies in the country. When you buy an index fund, you are not trying to beat the market. You are owning the market. That means if the market goes up, you go up. If it goes down, you go down. No guessing, no stock picking, no trying to outsmart everyone else. An actively managed fund is different. There is a portfolio manager or a team of managers making decisions. They choose which stocks to buy, which ones to avoid, and when to move money around. The goal is simple: beat the market, deliver higher returns than something like the TSX. And on paper, that sounds like the smarter option. Why settle for average when you can aim for better? But here is where things start to fall apart. In Canada, actively managed funds often charge between 1.5% and 2.5% per year. That is called the management expense ratio, or MER. Index funds are dramatically cheaper. Many are between 0.05% and 0.25%. At first glance, the difference between 0.2% and 2% does not feel like a big deal. But investing is not about 1 year, it is about decades. And fees compound, just like returns do. Let's walk through this slowly. You invest $10,000. You leave it for 25 years. The market returns 7% annually. With a low-cost index fund charging about 0.2%, your investment grows to roughly $52,000. Now take that exact same scenario, but with a 2% fee. Your return is effectively reduced, and your final amount drops to around $39,000. That is a $13,000 difference, and you did nothing different. Same market, same time, same starting money. The only difference was cost. Now think bigger. If you invest $100,000 instead of $10,000, that difference is not $13,000 anymore. It is over $100,000 lost to fees over time, and most people never even see it happening. Because it is not charged as a bill, it is quietly taken from your returns. This is the part most people do not hear. Over long periods, about 80% to 90% of actively managed funds underperform their benchmark. That means they fail to beat the very index they are trying to outperform. And that is after fees. Some do win in the short term. A few outperform for a few years. But consistently picking those winners ahead of time is extremely difficult. Even professionals struggle to do it. Because markets are competitive. Every trade you make is against someone else. Other investors, institutions, algorithms. Everyone is trying to find an edge. That makes the market surprisingly efficient. Prices already reflect most available information. So beating it consistently is incredibly hard. And when you add high fees on top of that, it becomes even harder. Index funds do not try to win. They remove the game entirely. They keep costs low. They eliminate decision-making errors. They stay fully invested. And they capture the overall growth of the economy. Instead of trying to be smarter than the market, they simply participate in it. For Canadian investors, this becomes even more powerful. Because you can combine low-cost index funds with tax-advantaged accounts, like a TFSA or an RRSP. Inside those accounts, your investments can grow with major tax advantages. So now you are not just reducing fees, you are also reducing taxes. That combination is extremely powerful over long periods. To be fair, active management is not completely useless. There are situations where it can make sense. In smaller markets where information is less efficient, in niche sectors, or in certain international markets. But those are specific cases. For the average investor building long-term wealth, broad, low-cost index investing wins far more often. There is also a psychological factor. Active investing feels productive. It feels like you are doing something, making decisions, taking action, trying to win. Index investing feels boring. But boring is often what works, because it removes emotional decisions. No panic selling, no chasing trends, no trying to time the perfect moment. Just consistent investing over time. You do not need to beat the market to build wealth. You need to stop losing to fees. Because over time, the biggest drag on your portfolio is not volatility, it is cost. Keep it simple. Keep costs low, stay consistent. That is how real investing works.